Hello, everyone. This is Zak Gardezy. I'm the host of Money Minutes. I'm also the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a certified financial planner and a private wealth advisor. So, on Money Minutes, I share with you the latest market headlines and my outlook for what's ahead. So, for this week's episode, there's a lot to discuss. I'll focus on two key topics. One of them is the Federal Reserve and their decision to keep interest rates where they're at. I'll give you an update on inflation and my overall outlook as it relates to interest rates for the rest of the year. Additionally, we'll talk about the biggest headline, which is the US conflict with Iran. I'll talk about my mid year market outlook, where I explicitly talked about this potential conflict, and then now we're seeing it actually playing out. So let's get right into this week's episode. So on June the 18th, the Federal Reserve met to decide what they're going to do with interest rates. Now, we expected that the Federal Reserve would not lower interest rates, which is the decision that they made. They decided to keep interest rates where they're at. But what was more important was the rationale for why. Now, some economists were arguing that the Federal Reserve should lower interest rates by at least 25 basis points. Now, of course, they didn't do this, and that was because, as the Fed chairman pointed out, although inflation has come down, it still remains sticky. They're not at the target level. And additionally, the impacts from tariffs are still unknown to the overall economy. The Fed is projecting higher inflation, even higher than what they were projecting before. So we'll have to see what the next few months lays out for us. If inflation continues to head downward, then it's pretty likely, and even many members of the Federal Reserve are considering lowering interest rates later this year, potentially the first rate cut to happen in September. Now, this goalpost has consistently moved further along. So, depending on what happens with inflation, it's possible we don't get any interest rate cuts this year. From an investment standpoint, what does this all mean for you? So, lower interest rates are better for stocks, it's better for private equity investments, but they do impact investments in areas such as floating rate or private credit investments. Slowly over time, as rates come down, you can expect your income that you derive from floating rate investments to come down as well. Now, that's not a huge problem for a lot of investors. And also, if the Fed really lowers interest rates at a pace of about 25 basis points per meeting, maybe does a couple this year, a couple next year, it's not going to make a huge impact on the income that's being derived from floating rate credit investments. And the diversification aspect, at least in my view, still makes them great investments for us to hold on to. But for bond investors, lower interest rates is actually a good thing. Your bonds typically go up in value. Now, it depends on duration and other components of the bonds that you hold, but generally, lowering of interest rates is a good thing for bonds in your portfolio. And as I mentioned earlier, lower interest rates typically enhance valuations for companies, which then helps the capital markets. You see more deal flow, you see more private equity deal flow, you see more IPO activity. So, coupled with all the good things that are going on with artificial intelligence and this new tech boom that we're seeing, this could be a really good event or really good series of events for technology and artificial intelligence, which generally does the best as interest rates start to get lowered. But we'll have to see again how the Federal Reserve reacts to the next few economic reports that we get and whether or not they actually pull through with lowering interest rates. And so that's the latest outlook and update from the Federal Reserve. And we'll be paying very close attention to as these economic developments continue over the next few months to see what the Federal Reserve ultimately does and if the September rate cut expectation actually holds true. On June 11th, I released my mid year market outlook, and I wrote about a lot of different things. And one of those topics, specifically about geopolitics and my outlook as it relates to the geopolitical world and investments, my biggest concern that I pointed out was a potential conflict between the United States and Iran. And this is based on all the rhetoric that I've been reading and seeing and hearing as it relates to U.S. demands for Iranian uranium enrichment, the Iranian government saying we're not going to negotiate on that at all, and both sides were deeply entrenched. And I just figured, you know what, based on how unwilling both sides are as it relates to diplomacy and these ultimatums, it was ultimately going to lead to some sort of a conflict. My base case was that diplomacy would ultimately prevail because I just think conflict like this is ridiculous and doesn't really serve any purpose. But ultimately, conflict did happen, as we're all well aware of. So, the day after I released my mid year market outlook, the Israeli military attacked the Iranian military. Lots of back and forth between the two countries. Eventually, over the weekend, the United States military destroyed multiple nuclear bases in Iran. And then, as the time of this recording, the Iranian military has responded by attacking U.S. military bases in Qatar. And so there's a lot of moving parts. The geopolitical chess match basically has gotten a lot more complicated. It's a lot more than just these three players, and there's a lot more to impact the economy, US economy, global economy, oil trade, stock market. There's so many different things that are happening at once. So it's important to spend a lot of time analyzing what's going on. But for the sake of not making this a 1 hour video, I'll just kind of explain what my general outlook is. So I believe that the conflict has peaked and is actually heading closer to the end of the conflict based on the actions that were taken by the Iranian military today. Whereas a lot like the previous strikes that they did on U.S. military bases, which were likely fully telegraphed to the U.S. military, caused little to no damage based on the current reports, and were more of a saving face type of approach by the Iranian government to show their people that, look, we responded. They'll tout it as victory. The American side repelled all of the missiles and the Qatari air defense systems as well. So they'll all say, we won on our side, they won on their side, and escalation won't occur. At least that's my initial view. Now, that's a great thing for the world and for the region. The other piece of news, which is the Iranian parliament saying, we're going to close the Strait of Hormuz. And we've talked about this last year when the conflict was kicking up again between Israel and Iran. And it typically happens every time Iran gets involved in a conflict. That's an initial threat that they make, which is we'll close this strait. Now, the Strait of Hormuz is a very important trading route. Much of the world's global oil supply actually flows through there, about 20% of the oil. And so, if the Iranians were to actually close the strait, it would cause most likely a global recession or massive oil prices around the world. So, it's a strong piece of leverage that they have, but they've never actually been able to successfully close the strait. And I think after seeing what the US military is able to do, likely not a wise idea for the Iranians to try and even close the strait, especially with all the naval firepower that's around that area. So, I think closing the strait is highly unlikely, one, from a military standpoint, but then two, the Chinese, who are the Iranians' top ally in the region and really in the world, they are the number one buyer of Iranian oil. And a significant amount of oil that the Chinese buy actually flows through the strait. Actually, about half of all the oil that they buy flows through the strait. So it would be a terrible idea for them to upset their strongest ally and their number one customer at the same time by closing the strait. So I think it's highly unlikely that the strait actually gets closed, but using it as a tool of leverage or a threat, trying to scare or get headlines or cause shock in the markets, is probably a tactic that the Iranian government is trying to utilize. Now, the markets have reacted pretty mutedly to what's been going on. Actually, last I checked, the stock market was positive opening up on Monday, which was after the strikes on nuclear bases and after the Iranian response. So the market's signaling that they don't think that this conflict is going to escalate, that there likely won't be boots on the ground anytime soon, and that the strait won't be closed. And so my outlook is the same. I think the conflict will de escalate from here. I don't think the strait gets closed. I think oil prices, although they are elevated since the conflict began, I don't think they get out of control like they have in wars past. So, overall, as an investor, this is that short term noise that I've talked about a lot, which is, we're going to get headlines like this, all sorts of different ones, whether it's related to COVID, fears of recession, real estate markets slowing down. I mean, there's all these different headlines that we get, conflicts kicking up here and there. But as long as we stay true to a particular investment thesis, which I still think the overwhelming thesis is US based stocks, large cap, artificial intelligence, technology driven, that's the long term approach that I'm taking with clients. As long as that thesis hasn't materially changed based on what's happening right now in the world, then there's no reason to make sudden adjustments to portfolios. I think, for example, a wrong move would be to start loading up on defense stocks because the potential onset of World War III. I think that's an emotional reaction to what's going on right now, not the rational one. So, avoiding irrational decisions, avoiding emotional decisions right now is likely the best course of action. And as we've seen throughout the year, whether it was the onset of tariffs, there's a lot of emotion around that period too. And the advice that I was giving to clients was just let the cool heads prevail. Eventually, things will all simmer down and we'll see what happens. And so ultimately, the market has recovered sharply since its lows earlier in April. And even with this conflict going on right now, there's a lot of conflict happening in the world. I don't think that this particular conflict is the one that should elicit an irrational or emotional response or fear, World War III, or any of those types of concerns. Now, again, before I turn this into a 1 hour video going down the rabbit hole of geopolitics, that's the overall outlook that I have for you. And despite all the negative headlines you might see or read about, I believe investors should remain calm, and I believe that Wellstone investors are perfectly positioned to take advantage of what's happening in the market, despite all of the crazy things that are going on. And if you're an investor that's holding on to a significant amount of cash, when you see volatility like this is a great time to work with your financial advisor to think about ways to get into the market. There could be stocks that fall a lot more than they should. The overall market could experience significant volatility more than it should. This may be an excellent buying opportunity for some investors as well. But again, that varies based on investor and what your specific goals are. So work with your financial advisor, reach us here at Wealthstone to get that specific advice. So thank you so much for tuning into this week's episode. I hope you took away some valuable information and hope to see you all again next time. Thank you very much.